Okay, Assalamualaikum and good afternoon, everybody. Welcome back to our session for this CRX 2001. Okay, CRX 2001. Okay, right now, currently we are in the week number 10. Okay, it's week number 10. Okay, next week there's going to be the semester break. Okay, and this Thursday probably we won't have any tutorials, so I've already posted up for my tutorial classes and for those who are to be present, so they can just submit their recorded presentation to me straight. Okay, and the other thing is I've got a question also. Students are asking about will there be any presentation for the assignment? Yes, there's going to be a presentation, a recorded presentation on the assignment, which I haven't posted the guidelines yet, but I will do in a day or two, in which this presentation assignment, okay, basically on the ratios that you've already done, you have to present it as in a recorded ones, and you need to post it up. Okay, so for that, I've already consulted with Dr. Edil. That one, it will comprise only 5%. Okay, so but then since the due date for the assignment on the written assignment is on the 4th of June, so I would delay for the what we call the assignment presentation. Okay, for the assignment presentation, that will be a week after that, which will be on the 11th of June. Okay, so you have 1 week to put up the recorded videos on your presentation and send it to the lecturers, okay, and which is either me or Edil. Okay, normally what I'll do is I'll post it up and send it to my MS team. But anyway, I'll put the guidelines in a day or two, all the written guidelines and the rubrics for the written presentation. No, for the assignment presentation or the. Okay, so that is on that the other one. Okay, so okay, for the questions, I'll entertain it after we've done the our lecture session. And for the meantime, what I'll do is that I'll just go straight to the lecture that we have today. Okay. So our lecture that we have today is on capital budgeting. On capital budgeting. Okay, this capital budgeting is basically when you were to assess a project, you need to be able to project what are the future cash flows that can derive from the project, or it can be you can buy a machine or equipment or something like that. So you need to able to evaluate the feasibility of the project, you know, what kind of benefit in terms of the benefit that it can provide, and then you have to compare with the initial cost. So there's two parts. Okay, one is on the chapter 11 that we are going to follow, which we are going to make projection on the projects or the equipment that we buy, what we expected, what are the expected cash flow we can generate it given the initial cost that we incurred initially. Okay, so that will be on the chapter 11. Chapter 10 is actually after the fact, after you've already done projecting all the free cash flows that you have, okay, that you need to do for assessing the project or buying the capital expenditure, be it machine, equipment, plants, or whatever it is, then you need to apply the capital budgeting technique. So this one is basically the post after the doing the projection. Okay, so then you apply the technique. So the technique is basically to make the final decision. Okay, so we are going to apply several techniques, and from these techniques, then we can come up with a decision, a firm decision, whether we are going to go ahead buying or not buying or we are going to go ahead or not going ahead with the project. So that's basically the gist um, of this chapter. So actually it's chapter 10 and chapter 11 together, but we'll start with chapter 11, which is the after effect. After you have already done the projection of free cash flows, you would like to assess it. So the assessing technique is where we're going to learn today. Okay, let me see. Hold on, let me check all the. Hold on. Okay, hopefully check all the. Okay. Okay, let's look at our learning goals for today. Our learning goals for today is the first one, understanding the key elements of the capital budgeting process. Okay, and then let me see. Okay, that is the first goal. Okay, what is capital budgeting all about? Okay, I've already given you the run through a little bit on the what is capital budgeting. And then we are going to go through on all the techniques. Learning goal 2, which is to calculate, interpret, and evaluate the payback period. This is the first one. And then followed by learning goal 3, calculate, interpret, and evaluate the net present value of NPV and economic value added, which is EVA. It's much more like a sibling to NPV. Then we are going to go through learning goal 4, which is calculate, interpret, and evaluate the internal rate of return on IRR, which is basically the fourth or the fifth method here. Okay. Before that, we also get another method I didn't mention, which is a profitability index. And then we have learning goal 5, use net present value profiles to compare NPV and IRR techniques. And we are going to look and discussing about the effect of using NPV and IRR, because these are the two major techniques that has been used by analysts for quite a number of years already. Okay, so learning goal 6, discuss NPV and IRR in terms of conflicting ranks and the strength of each approach. So here we're going to discuss that sometimes when you do evaluation, if you were to use simultaneous techniques together, you find that at times NPV will show the certain asset is a better choice, whereas IRR would say differently, in which another asset would be a better choice. So we are going to discuss if we have a conflicting result. So the question first is that before that, we need to understand how to come up with the assessment, or how going to come up with, figure out the NPV and R and the rest of them first. Okay, let's look at the capital budgeting. What it is the process of evaluating and selecting long-term investments that contribute to the firm's goal of maximizing owner's wealth. So basically, we are going to evaluate a long-term investment, which is the capital expenditure, in which how we're going to assess, because when we were to involve in the projects or buying capital expenditure, we like to see whether how it can able to provide the benefit of value added to the company, okay, that it has. So we need to able to do that. Okay, and then the motives of capital expenditure. So the capital budgeting is only applies on capital expenditure. So what is capital expenditure? Just to make everybody understood. Sometimes, some of the students may get confused. What's the difference between capital expenditure and operating expenditure? So the capital expenditure is an outlay of funds by the firm that the firm expects to produce benefits over a period of time greater than 1 year. So any types of equipment, any types of anything that the lifespan has greater, it encompasses more than 1 year, the usage of it is more than a year, then normally you consider it as a capital expenditure. Whereas operating expenditure and outlay of funds by the firm resulting in benefits received from within a year. So meaning to say that any expenses, be it that you spend it and it just the duration is 1 year period, and then you have to pay within every time. So the lifespan is shorter than 1 year. Okay, so we'll discuss that in some of the videos I'm going to put up in the next one. Okay, let's look at how the video look on the capital budgeting.
Firms use capital budgeting to determine if a project like building a new plant or developing a new product is worth pursuing. The three most common capital budgeting approaches are the net present value, the internal rate of return, and the payback periods method. Most analysts prefer using net present value, which translates the value of a specific stream of future cash flows into today's dollars. The method is useful and easy to understand. If the present value of a project's future cash inflows is higher than its outflow today, it should be profitable. The internal rate of return is an interest rate the firm compares to the cost paid to obtain the funds to finance a project. If the internal rate of return on a project exceeds its cost of obtaining the funds, it's a good investment. The payback period calculates how long it will take to recoup a project's expenditures. For example, buying new manufacturing equipment may cost ABC Corporation $1 million. The payback period reveals how long it will take for the new machinery to generate $1 million in cash inflows. Companies with liquidity concerns look closely at the payback period. It can help them prevent from overextending themselves, and it's easy to calculate. The internal rate of return and the payback period do not factor the time value of money, which says money currently available is worth more than the same amount in the future. Nor does the payback period include cash flows a project might bring at the end of its life, such as the salvage value for selling a piece of machinery.
So this video encompasses everything that you're going to learn for the whole duration today. So it's within 1 more minute, but we'll go more detail and going through all each in and every part of the technique. Okay, hopefully you guys can hear clearly. So if you don't unable to hear clearly, let me know on that. Okay. All right, let's move on to the next one. Okay, let's make sure we understand what is capital expenditure. I've got a video also discussing what is capital expenditure.
CapEx is short for capital expenditure and refers to a company's spending on physical assets like buildings or equipment. Capital expenditures are unusual in that they cannot be deducted from income for tax purposes. Instead, the value of the capital expenditure is added to the company's assets, and the value is reduced every year through depreciation and amortization. CapEx is an important part of a company's investment spending and cash flow. In many industries, physical assets are essential for the production of goods. A steel company cannot manufacture steel without furnaces, and so on. Every year, these companies must spend money to replace or repair old equipment, or expand operations with the purchase of new equipment. This spending reduces the cash flow of the company. Many investors focus on free cash flow, which is the remaining cash after capital expenditures have been subtracted from the operating cash flow. Free cash flow represents the cash that a company is able to generate after laying out the money required to maintain or expand its asset base. Some investors will avoid industries or companies with high annual CapEx requirements. Investors should follow CapEx not only to determine if a company is more or less efficient than its rivals, but also to determine if a company has been underinvesting and could potentially suffer from less efficiency, lower margins, and higher future spending requirements.
Okay, so that is an explanation on what is capital expenditure. Okay, let's look at the other one. How do they define operating expenditure or OPEX?
An operating expense is any expenditure made for the purpose of operating a business. These expenses are the day-to-day costs that help keep the business going. Operating expenses are reflected on the income statement and are a component of operating income. Typical operating expenses are accounting and legal fees, bank charges, sales and marketing expenses, travel and entertainment, interest paid on debt, non-capitalized research and development, office supplies, rent, repair and maintenance, utility expenses, costs of goods sold, and salary and wages. Management's goal is to maximize profits. They have two interrelated options for achieving this: increasing revenue and decreasing operating expenses. Management sometimes makes the mistake of focusing entirely on cutting operating expenses to increase profits. But ultimately, overly severe cuts to operating expenses reduce productivity and lowers profit. For instance, management could increase short-term profitability by reducing an operating expense such as advertising. But in the long run, sales will decline as fewer customers are aware of the company and its products. Instead, the challenge is to keep operating expenses as low as possible, but still maintain the ability to increase sales.
So basically, the diagram, the graphics is showing that you need to spend operating expenses wisely. Okay, so those are the list of items that's considered operating expenses. So basically, in the nutshell, operating expenses are expenses that you book everything within the year's time, whereas a capex, in which you don't book all the amount, you need to depreciate it to reflect in the income statement. Okay, so let's look at the process of capital budgeting. What does that mean? When you were to come up with a project, okay, or buying a heavy expensive equipment in the company, so usually is a job of a financial analyst to evaluate. Okay, so and the one who come up with a proposal are from engineering side, can be from operation side, because they need to enhance or to add to increase the productivity of what they are doing in the operation side. So so we are looking at the perspective of a financial analyst. So what do they do? Let's look at overview of. No, I think this is over too much on the volume side. I need to decrease somehow. Control the volume at times. Let's look at overview of the capital budgeting. So again, the capital budgeting process consists of 5 distinct but interrelated steps, which is proposal generation, review and analysis, decision making, implementation, and follow-up. Okay, number 1 step in the process: proposal generation. Managers at all levels in the business make proposals for new investment projects that are reviewed by finance personnel. Proposals that require large outlay receive greater scrutiny than less costly ones. Number 2, review analysis. Financial managers perform formal review and analysis to assess the merits of investment proposal. Okay, so if you're in a company, it depends on the size of the project or the size of the equipment. You can buy just a PC. Okay, you need to evaluate it. Okay, even the small PC. Okay, go to somebody who's in charge in finance doing this capital budgeting analysis. So probably if you want to buy equipment lesser than probably 50,000, you don't need. You just send it to the finance department, and they have somebody who's in charge to evaluate your proposal. So the proposal will include, buying that machine, how is it going to benefit that machine, and what kind of, income or benefits that it can provide given the cost or something like that. Okay, but in a larger scale, if it requires an investment or project that probably costs more than, let's say, a few $100,000 or millions of dollars, you need to have a team for discussion. So you probably have a subcommittee or a task force discussing and comprising of from operation, marketing, you name it, all the departments that is related to it, okay, including the key person in the task force is the finance. And what they're going to do is that they're going to discuss from period to period as new information comes out and gather, if they were to put in a broader scale proposal, you've got contribution numbers or data from the operation side, they got marketing side, you got from engineering side, you name it. Okay, so everybody contribute and put it in a large scale proposal, and then they come up their own individual numbers, and the numbers are going to be discussed by each other, and they're going to come up with a comprehensive combined figures, and then it's going to be evaluated. At the same time, the finance person going to provide inputs on it, what are those numbers which are considered, which are too much or something like that, and then you're going to put a huge proposal there, and then the numbers are going to be re-evaluated again by the finance person, and then once he make the assessment, and then he's going to probably provide a little bit of summary, and that summary will be brought up to his senior management, can be the senior manager, can be the general manager, and the manager will look again at the proposal, reassess the viability, and then make further recommendation to the top management. Okay, so I think I've already gone through the third one, the decision making. Step 3, which is the decision making. Firms typically delegate capital expenditure decisions on the basis of dollar limits. Generally, the board of directors or a team of very senior executives must authorize expenditure beyond a certain amount. And often plant managers have authority to make decisions necessary to keep the production line moving. So it depends on how big the assessment is. So once that major proposal has come to general manager, and then he will push up to the top management, will comprise all the CFOs or CEOs. They have their own team to discuss much more detail or to make the decisive decision to go ahead with the project. Sometimes the amount is so huge, you need to get the approval up to the board of directors. So the board of directors probably will sit once a month or twice in a month, and they will look into that major proposal, and then they will make the final approval whether to go ahead, so that everybody understand the impact of going into that major project, what are the expectations and what are the repercussions if things doesn't turn out as what you expected. So that's a decision making. And then we go to the fourth one in terms of the processes. Step 4, implementation. Following approval, firms make expenditures and implements projects. Expenditure for large project often occurs in phases. 5, follow-up. Managers monitor results and compare actual costs and benefits to the projects that they originally used to justify making the investment. Managers may take actions to expand, contract, or shut down investment when actual outcomes differ from projected ones. So basically, once everybody have made the decision, it depends on the level of the amount, that to what level being approved. So when that level has approved on going with the buying the equipment or going with the project, then it goes for the implementation. So the implementation will go, probably takes a few months, to implement it, or takes 1 year or something like that. It depends. And then the follow-up after it has been in operation for quite some time, then you look at the actual contribution that project able to provide of that huge machine, okay, that able to once it's operation, how much is able to produce, and you look at the cost that entails to it. So at the end of the day, the follow-up is the decisive whether your projected revenue or cash flow generated, or the cost that entails to it is more or less aligned to the what is being depicted in the proposal. So if you have the cost overrun, then probably then you bring up the top management, and then they said, okay, all right, it's still tolerable. But if it's go beyond the actual cost, you know, it becomes uncontrollable, probably you need to stop the project. Otherwise, it's going to envelope until, you know, it has a major impact on the bottom line of the whole company. So you know, so it's something that needs to be done. So especially when you want to come up with a proposal, you need to really thinking in so many ways. You have to come up with all the scenarios, make sure that you're able to cover all the grounds. And if you were to go ahead, that meaning you will go ahead, you're very confident to a certain percentage that this is the most likely what actually would happen. And if any setback were to happen, you would already have plan B or something like that to encounter or to deal with all those. Okay, so so there can be much more complication to it, but that is basically the step in the processes. Okay, let's look at the types of when we talk about capital budgeting, what aspect are we looking at? So here we have, we can categorize it into independent project and mutually exclusive project. So independent projects are projects whose cash flows are unrelated or independent of one another. Accepting or rejecting one project does not change the desirability of the project. So basically independent project where as long as a project is viable and meets the criteria that you set, then you go ahead. Okay, and then you have mutually exclusive project, meaning to say in a situation where projects that compete with one another so that the acceptance of one eliminates from further consideration all other projects that serve a similar function. Mutually exclusive is that you are in the situation where you need to choose the best among the best or few among the rest. So for example, you have 5 projects, and out of the 5 projects, 3 are viable, 3 meets the criteria, but then you only have to choose 1 or 2 out of the 3. So here we are talking mutually exclusive project because you cannot implement all 3 together, probably because of the limited budget or some condition restriction that requires you only to choose 2. Okay, whereas independent type project, you can choose all 3 which are viable. But mutually exclusive projects, you are being subject to certain constraint in which you cannot choose all of them together. And then you have those can be categorized, those who are unlimited funds and capital rationing. So the unlimited funds define here the financial situation in which a firm is able to accept all independent projects that provide acceptable return. So this one is related to independent projects where you don't have any limitation on selecting the projects. As long as they are viable, then they are okay. So they are related to independent types of project. And capital rationing, the financial situation in which a firm has only a fixed number of dollars available for capital expenditure and numerous projects compete for these dollars. So here is more related to the mutually exclusive types of project where you have some restriction, limited capital, you need to choose among the best. Okay, and then you have situation where whether it comes out whether you accept or reject a project. So the evaluation of the capital expenditure proposal to determine whether they meet the firm's minimum acceptance criteria. So here we know that in independent project, you know, whether we accept or reject the project, and also the ranking approach. The ranking approach of capital expenditure on the basis of some predetermined measures, such as how much value the project creates for shareholders. So based on all the techniques we're going to learn, probably we have to rate the projects according to ranking. Okay, this is the first one that we prefer, followed by second, third. Okay, more or less it is related to mutually exclusive projects where we need to rank it so that we can choose 2 out of 3 or 1 out of 3 in that manner. Okay, so that's how we the approaches that we can meet when we were to deal with capital budgeting. Okay, let's look a little bit more on this technique, capital budgeting techniques. Capital budgeting techniques. Overview of capital budgeting. To ensure the investment projects a firm selects have the best chance of increasing the value of the firm, financial managers need tools to help them evaluate the merits of individual projects and to rank competing investments. A number of techniques are available for performing such analysis. The best technique take into account the time value of money as well as the trade-off between the risk and return. Project evaluation methods that fail to account for money's time value or for risk may not lead to shareholders' value maximization. So here we are talking about, in general, what the techniques that we are going to discuss later on. There are those who are considered the prevailing techniques that considered acceptable techniques that you can rely upon, and those that are less reliable. Okay, so the less reliable when it doesn't take into consideration on the time value of money, and also it doesn't into consideration eventually how it able to maximize the shareholders' value. Okay, so the one that is the better ones are able to encompass, able to consider these two aspects, the time value money, and also at the end you can see the value that it or the benefit it able to provide. Okay, so okay, let's look some of the techniques here. Okay, let's look at the situation. Okay, look at the hypothetical company called Bennett Company. Bennett's company's relevant cash flow. We will use one basic problem to illustrate all the techniques described in this chapter. The problem concerns Bennett Company, which is a medium-sized metal fabricator that is currently contemplating two projects with conventional cash flow patterns. Project A requires an initial investment of $420,000 and B requires an initial investment of $450,000. The project cash flow for the two projects appear in the table 10.1 and in the timeline in figure 10.1. So project A, you can see that this and B are the initial investment and these are the cash flows. The project A, you have a very consistent cash flow throughout the 5 years, whereas project B, you have a mixed cash flow. So the unconventional, when it says conventional and unconventional cash flow, is that the unconventional refers to, let's say in 1 year you have a positive cash flow, and then another year the company incurred losses, and then you got then the next year you got a positive return, or you got positive cash flow and the positive, and then you have a minus cash flow. So those are considered unconventional. They are not very consistent in providing the returns to the company. Okay, so if you were to depict through the timeline, that's how we put it. The initial investment normally reflect as a cash outflow, which represent as minus figure, and the rest are the expected cash inflow that the company were to expect from launching these two projects. Okay, project A and or project B. Okay, let's look at the first technique that we are going to use, which is payback period. The payback period is the time it takes an investment to generate cash inflow sufficient to recoup the initial outlay required to make the investment. So basically we are talking about period here. So how long does it take to recoup or recover the initial cost or initial investment that the company has already invested? So the decision criteria here is that if the payback period is less than the maximum acceptable payback period, accept the project. If the payback period is greater than the maximum acceptable payback period, reject the project. So basically you would have a certain criteria. So let's say the project needs to recover its initial investment within 10 years. Anything that is lesser than 10 years, we accept. Anything that takes more than 10 years, we reject. Okay, let's look from the video side here what it meant by payback period.
Payback period is the time it takes for an investment to generate an amount of income or cash equal to the cost of the investment. The shorter the payback period, the better the investment is judged to be. Managers and investors use payback period to make quick judgments about a particular investment or capital purchase. The payback period equal cost of investment divided by annual cash flows. The main drawback of payback period analysis is that it does not take into account the time value of money. A dollar today is worth more than a dollar in the future. Payback period also does not take into account what happens after payback, and thus ignores the overall profitability of the investment. These two limitations of payback period analysis are why most managers and investors feel net present value, NPV, is a superior tool for making an investment decision. Sonny owns a golf cart manufacturing business in Texas. Sonny's business uses a lot of electricity, and the monthly electric bill is very high. He wants to reduce his bill and is thinking of installing solar panels on the roof of his manufacturing building. It will cost $90,000 to buy and install solar panels. With the panels installed, Sonny estimates his electric bill will have a savings of $24,000. Dividing the total cost of the solar panels, $90,000, by the annual cash flow, $24,000, the payback period is 3.75 years. So in 3 years and 9 months, Sonny will not only reduce his carbon footprint, but also start seeing the benefits of his investment on his electric bill.
So there's a bit of a nutshell on what payback period is. Okay, let's look at the way what type of figures we are going to encounter when we are trying to figure out calculating the payback period. For example, in company for Bennett, for project A, okay, for project A, it is expected to provide a cash inflow of $140,000 for the next 5 years. So given the fact that the $140,000 is consistently being made, okay, every year out of the initial investment of $420,000. So what we do is that we just divide it straight. 420,000 divided by 140,000, so we got 3 years. But for project B, it's a little bit different. Project B, you've got a different cash flows. You got very inconsistent cash flows. So what we do is that we come up with a table here. So you got first column, second column is the amount, the third column is the cumulative amount. So we just what we do is that the 0 year indicates the initial investment, which is the which is the cash outflow, which is the minus 450,000. For the first year, 280,000. So given the fact that we are able to cover some part of the initial cost, so the leftover amount that we have here, basically we take minus 450 plus 280,000, so you get minus 170,000. Then from that amount on the second year, you're able to generate 120,000. So that 120,000 we plus the minus 170,000, you are left over with 50,000. And then by the third year, you are able to recover all the initial 50,000. So therefore, we know that for project B, basically the recuperating or recovering period is between 2 and 3 years. So here what we do is that we know definitely is 2 years. So 2 plus then the amount that we need to cover for the third year is basically the amount that we need to cover after the second year is 50,000. So that 50,000 we are able to recover within the third year, but the third year we already make 100,000. So basically what we do is that we just take 50,000 divided by 100,000. So that's what we do over here. 50 divided 100,000, we have another half a year there. So you got 2 plus half, you got 2.5 years to as the payback for the project B. So what does it entails? Okay, let's look at the analysis here. If Bennett's maximum acceptable payback period were 2.75 years, project A which is 3.0 years, would be rejected, and project B, which is 2.5 years, would be accepted. If the maximum acceptable payback period were 2.25 years, both projects would be rejected. If the projects were being ranked B, which is 2.5 years, would be preferred over A because it has a shorter payback period. However, note that no matter what payback period Bennett requires, it is unclear from payback analysis which investment will do the most to increase shareholders' wealth. All we can say is that the project B recoups the initial investment more rapidly than does project A. So by cursory, you can find that project B is much better than project A because it's able to recover the initial investment much earlier. But in general, by just looking at the period, it doesn't tell much about how to maximize the shareholders' wealth. Okay, so let me turn out the volume a little bit more. I think it is less. I don't know how about this. 67, 66, and see how it works. Okay. Okay, payback in India. Okay, there's some supplementaries being provided. In 2017, survey of firms in India found that 2/3 of those firms always or almost always conducted payback analysis when they made major investment decisions. Similar to result found in US firms, small companies in India were more likely than large firms to use payback approach. For all its flaws, the payback approach will still sees widespread use around the world. Okay, so even though it has its flaws, but still a lot of companies still uses that. Okay, quite interesting there. So let's look at the pros and cons furthermore about this using this payback period. Pros and cons of payback analysis. Number one, large firms sometimes use the payback approach to evaluate small projects or as one of the several metrics used to judge a largest project's merits, as small firms use it to evaluate most projects. Number two, the payback method's popularity results from its simplicity and intuitive appeal. Number three, by measuring how quickly the firm recovers its initial investment, the payback period also gives at least some consideration to the timing of cash flows. So basically, okay, so we can see that most small companies tend to use it, I think, because it's a very simple and a measure of how to use it intuitively. Intuitively, you can calculate at the back of your mind whether you're able to recover the initial investment, which investment you're able to recover much faster. You can just do a simple calculation here. So because it's so simple, so that's why it's widely being used. Okay, and also you have the timing. So sometimes in the time period for certain companies, certain valuation investment plays an important significance also. So that's why it's very popular, even though you got a lot of setback using this approach. Likewise, the payback approach offers a crude way to adjust for project risk if managers require a faster payback on riskier endeavors. The major weaknesses of the payback period is that the appropriate payback period is merely a subjectively determined number. Therefore, no firm connection exists between the payback period and the goal of shareholder wealth maximization. So basically what we can say here is that the criteria whether to accept or not accept becomes from certain intuition from a company or some, just a quick, a quick suggestion to say, okay, we need to have it, able, as long as able to have the project initial investment recover within 6 years, then we are okay with it. So the question is, how do you come up with the 6 years? How do you, is there any justification in coming out with that 6-year period? Is there any scientific explanation to that? So sometimes it's very difficult to come up with a proper justification. Usually the 6-year period or the threshold period is come from the intuition based on historical decision making. So probably it's not good enough when we are dealing with a huge amount of investments. Okay, so the question here is that it's not good enough because it doesn't tell the whole story of how to maximize the shareholders' wealth. Okay, this one just skip here. This one is just a supplementary. Let's look at the cons. Okay, based on this next two example. Dearman Enterprises, a small medical appliance manufacturer, is considering two mutually exclusive projects named Gold and Silver. That is, Dearmans can invest in only one project, not both. The firm uses the payback period to choose projects, and it requires any investment to recover its initial cost within 4 years. The cash flow and payback period for each project appears in Table 10.2. Both projects have 3 years payback period, which would suggest that they are equally desirable. But comparing the cash flow patterns of each investment immediately reveals that silver produces more cash flow sooner than gold. In year 1, silver generates 40,000 in cash flow compared to just 50,000 for gold. We know that because money has a time value, it is preferable to receive cash flow sooner rather than later. The payback approach fails to recognize that benefit. Any capital budgeting tool that properly accounts for the time value of money would suggest that Project Silver is better for shareholder than Project Gold. Okay, just let me make a correction in my when I make the explanation is not 50,000, it's only 5,000 when we are comparing between Project Silver first year versus Project Gold first year initial cash flows. So the question here is that here you can see that even though the payback period is an even keel, that means to say, they able to recover within the next 3 years, but there's more to it. By just looking at the numbers, you can tell you that Project Silver, it gives a much higher return in the initial period rather than Project Gold, which only gives 40,000 in the 3rd year. So given the fact that we know based on the time value of money, would you rather receive $10 today or $10 within, let's say, a month from now? For sure, you would prefer that money, the same amount, to receive by today, because you got more certainty, and then you can reinvest that $10 or whatever it is, the amount that you are receiving. So it fails to look into the impact of the time value of money. Okay, let's look at the second disadvantages using that payback period. Rashid Company, a software developer, has two investment opportunities, X and Y. Data for X and Y appear in Table 10.3. The payback period for Project X is 2 years. For Project Y, it is 3 years. Strict adherence to the payback approach suggests that Project X is preferable to Project Y. However, if we look beyond the payback period, we see that Project X returned only an additional $1,200, which is $1,000 in year 3, another $100 in year 4, and $100 in year 5. Whereas Project Y returns an additional $7,000, which is $4,000 in year 4 and $3,000 in year 5. On the basis of this information, Project Y appears preferable to X. The payback approach ignored the cash inflows occurring after the end of the payback period. So it ignores the after fact. After you already considered the payback, then the amount of money that can be generated after that is simply you don't take into consideration. So that is the disadvantages of having this payback period. Even though it's very popular, but there are a lot of holes to it. Okay, so Okay, let's look at the next one. So in a nutshell, what can we say about this payback? Payback period is, I mean, you can use. It's easier to use. Most companies, they use it, okay, but they don't use it as solely. They will use with other techniques, you know, but usually these are preliminary. When you make a judgment on a project, usually, because it's very simple, you can intuitively able to calculate at the back of your mind. So it is a good one. So you can get somebody, okay, whether I think this project is good as compared to that, okay, and then you may just make a very quick calculation. That means to say in terms of recuperating, able to recover much faster, project A is much better, you know, but it gives you some ideas, you know, for you to start off, able to make judgment, but then you need to extend, you need to use other techniques to supplement, to make sure that your intuition is correct or not. Okay, so let's look at other techniques that can supplement the payback period. Okay, the one that we're going to use, the one that is prevalent, that is being discussed, being mentioned in the video, is a net present value method. What is it? It's a capital budgeting technique that measures the investment value by calculating the present value of its initial cash inflows and outflow. So what you're looking is the NPV is equivalent to the present value of the cash flows. So here is the formula. NPV, what you are doing is that you are looking at all the stream of cash flow being generated from T1 to N, and then you discount it by its required rate of return or its weightage, average cost of capital of the company. Here you divide it, or you're discounting. Basically what it's saying here is that you're discounting all the cash flows, meaning to say you are taking the present value of all these cash flows here minus the initial investment that you invest in, usually is reflected in year 0. Okay, let's look further into it. So not every investment opportunity has this kind of standard cash flow pattern. Sometimes firms receive money upfront and have to pay out cash in later years. Other times, a project requires several years of cash outflows before inflows begin. Therefore, a more general equation for investment NPV is, which is NPV is equivalent to summation from period T0 to period N, and you have the series of cash flow divided by 1 plus R, which is the required rate of return for each of the following periods. So the decision criteria that we abide to is that if the NPV is greater than $0, accept the project. Or in other words, if it is positive, then accept it. If it's less than 0 or negative, reject the project. Okay, just like to take note is I'm missing the minus initial investment. Cash flow 0, which is the initial investment. So the criteria here we are saying here is that if NPV is greater than 0, accept the project. So what does that mean? What it meant is if it accept more than 0, meaning to say that if this amount here is greater than the initial investment here, when here we discounted it, okay, if this value of all the cash flow exceed its initial investment, so you're going to have a positive figure which is greater than 0. So meaning to say you go ahead with the project. But if this present value of all the discounted cash flow is lesser than its initial investment, then you're going to have a negative figure which is lesser than 0, meaning to say the project is worthwhile because you cannot able to cover the initial investment, and basically given the required rate of return that you need to have from the expected cash flow here, is unable to cover its initial cost. So that's the reason why it becomes a negative. So in other words, when we were thinking about later on, we're going to discuss this when we deal with capital projects, the weightage average of capital required return is very important. So the higher is the required return here, your discounted amount, the present value of discounted amount will be much lower. Okay, so it would have an impact whether to accept or reject the project, because it will tell whether the numbers that you come here is positive or negative. Okay, let's move on. Okay, let's look at how we were to calculate those figures using NPV method. Okay, the example given in the book. So let's have a look at this example here. How are we going to use the financial calculator to calculate for project A, which we can see that it has a cash flow of 140,000 every year for the next 5 years, with the initial investment of $420,000 and at the required rate of return, which is at 10%. So using HP10B plus, first of all, we check our compounding period. Here is 12. We have to reset it once per year. So we just press 1, orange, and PYR. Then we got it once per year. And we know that when we check, press orange and clear. So the next step is to use the CFJ function. So we type in 420,000, which is our initial investment. Then we minus there, and then it becomes CFJ for 0 period. Then the next one is 140,000. So 140,000 for the first year of the cash inflows. We got so that will signify 140,000 for the first year. So but it's going to repeat for 5 years. So in order to do that, what we do is that we have to signify that it's going to be repeated 5 times, including the initial one. So we press 5, orange, and NJ. So it's going to repeat for 5 years. Then the next step is to key in the 10% required rate of return, 10%, 10I. Then we press to find out what is the NPV. Press orange and NPV. So we got the answer, which is 110,710, which is the same as the one over here. Okay, so that is for the project A. So project A, so the function that we use is the CF function. Okay, all right. Let's look at project B, how we were to do the calculation here. For the second one, for project B, it has varied cash flows. Okay, so we are going to input it one by one for each of the period. So let's clear the memory first, and then you key in the first amount, which is 450,000, which is the initial outflow. So we put a minus here. So you press CFJ, and then the rest we just key in as it is, 280,000 for the first year. Then we have 120,000 for the second year, and then we have 100,000 for the third year, and then another 100,000. Or what we can do is that we can, rather than repeat it, we can also press the 3 times NJ, which is 3 orange and NJ. And then the next one, we key in the 10% rate, required rate of return. And then we press NPV, and the amount we got is $109,243, which is more or less the same as here. Okay, so there's a difference that we got. One is for project A, we got 110,000. For project B, we got 109,000. So what it entails is that given the value cash stream amount that we expected to generate, and given our required rate of return is 10%, so all that amount, when we compare with the initial cost, is able to provide an added value of cash flow of more than, let's say, for project A, 110,000, the other project B is 109,000. So it's over and above the initial amount that we spend, given our required rate of return is at 10%. So these are the amount of values, amount of benefits that are provided. So you can interpret in that sense. Okay, so What is it? Okay, let's look at this narration here. We can illustrate the NPV approach by using the Bennett company data presented in table 10.1. Figure 10.2 shows the calculation of NPV for project A and B, assuming that Bennett discount project cash flows at 10%. This calculation results in net present value for project A and B of $110,710 and $109,244 respectively. Both projects are acceptable because the net present value of each project is greater than 0. If the project were being ranked, however, project A would be considered superior to B because its net present value is higher than that of B. So when we were to rank it, it's just a project A is marginally better, 110,000 as compared to 109,000. So I just would like to mention in the book, it doesn't tell you using the CFJ function. So in the book, the approach that it goes here is that for evaluating project A, what it does is that you take all the present value of this. Okay, so the way how you would have done it here is that you key in terms of financial calculator, PMT as 140,000. The periods that you are generating is 5N, 5 periods, 5N, and then I is the interest rate. Interest rate is 10%, and then you press the PV. So PV of annuity or all this amount. So you get all this amount here. Then once you get the amount, then you plus the initial investment, which is basically a minus figure, so you get NPV 110,000. For project B, what the book would have done here was the way how it is illustrated here is that what you do is that you do a present value for every of the future value of every year here. So in other words, you take, for example, in year 1, you take in your calculator, what you do is that you put 280,000 as your future value. The period N is equivalent to 1. I is 10%, and then you PV it, so you get 254,545. For the second year, what you do the same thing is that you just FV as equivalent to 120,000. The period is 2 years, N is equivalent to 2. I is equivalent to 10%, and you PV it, you get 99,000. So basically, you are going to do every one of those years here, okay, according to the book, and then you summarize it, you sum it, so you get around 559,000, and then you plus the initial cost. So therefore you get 109,244. So, but basically, that's what I'm saying here is that the way how we how being shown just now using the CF function is much more better in the sense that, you know, you don't have to repeat all the steps interactively and can save a lot of your time there, you know. So I just would like to say that sometimes you tend to read the books and then you might say how come the book are using this method, whereas the one that I'm showing in the slide is a bit different. But I'm just saying the comparison, you know, there's no right or wrong here. It's just that sometimes you need to save more time. You like to use the much efficient method in order to derive to the same answer. Okay, let's look at the other method, a sub method. We call it the profitability index. What is it? NPV and profitability index. For a project that has an initial cash outflow followed by cash inflows, and the profitability index PI is simply equal to the present value of cash inflows divided by the absolute value of the initial cash outflow. So what we are doing here is that it's more or less the same of NPV. Is NPV, what you do is that you minus the initial cash flows, initial investment. Here, instead of minusing, what you do is that you divide So how do we do that? How do you figure it out, you know? So let's look at this, the result here. NPV and profitability index. PI, which is profitability index, a short name greater than 1.0, implies that the present value of cash flows is greater than the absolute value of the initial cash outflow. So a profitability index greater than 1.0 corresponds to a net present value greater than 0. In other words, the NPV and PI methods will always come to the same conclusion regarding whether a particular investment is worth doing or not. Let's go back to figure 10.2, which shows the present value of cash flows for project A and B to calculate the PI for each abandoned investment option. So if we were to look at it, we just take for PI for project A, which is 530,710, divided by the initial investment, which is $420,000, we have 1.26, and PI for the project B, which is the present value of project B, which is 559,244 divided by 450,000, you have equivalent to 1.24. According to the profitability index, both projects are acceptable because PI is greater than 0 for both. Which shouldn't be surprising because we already know that both projects have positive NPV. Furthermore, in this particular case, the NPV rule and the PI both indicate that the project A is preferred over project B because of its greater value. It's not always true that the NPV and PI methods will rank projects in exactly the same order. Different rankings can occur when alternative project requires initial outlay that have very different magnitude. Okay, so basically that's the way how you decide it. Anything that is greater than 1, then you accept, which lesser than 1, we need to say in decimal figure, then you reject it based on using this PI method. Okay, let's look at how we do our calculation here. Let's see how we calculated the profitability index for project B, in which, how do we get that 559,244 using the financial calculator. Okay, let's bring it up, and which is 559,000 also being reflected here in the timeline here. So first of all, we clear our memory, and then we key in the amount. So the amount that we need to key in is all this amount here except the minus $450,000. So we zeroize this one, and the rest we key in as what it is. So we press 0 CFJ, and then just to make it easier, just take it without the thousands, so 280 CFJ, 120 for the second year, and then 100,000 for the third year, and then it repeated for 3 times. So we take 3 orange and NJ, and then what we're going to do is that we're going to key in the percent, which is 10% there, 10I, and then we press orange and NPV. So we got around 559,244, and just to make it the real figure here, we times 1,000, so we got 559,243. Okay, or we just take out the decimals, orange, display, and 0. So you get 559,244, and then we divide it by 450,000 divided by 450.3 there, and that's the answer. And then we have to bring in the decimal back because there's no decimal, orange, display, and 2. So we get around 1.24, the profitability index. More or less, profitability index is like you're doing NPV. It's just that you are not included the initial investment when you key in all the numbers. So you make sure you 0, when you key in the first amount, you put it as 0, so 0 CFJ. Okay, let's look at the other method that we are going to also delve, which is a newer one. Okay, not the traditional one. The traditional ones are basically the, as I mentioned, payback, NPV, net present value, and another one. Okay, this one is a newer set. We call it the economic value added. So what does that mean here? NPV and economic value added. Number one, economic value added, or EVA, a registered trademark of the consulting firm Stern, Stewart and Company, is another close cousin of the NPV method. Number two, whereas the NPV approach calculates the value of an investment over its entire life, the EVA approach gives managers a tool to measure an investment performance on a year-by-year basis. Number three, the EVA method begins the same way that NPV does, by calculating a project's net cash flows. Number four, however, the EVA approach subtracts from these cash flows a charge that is designed to capture the returns that the firm's investors demand on the project. Number five, that is, the EVA calculation asks whether a project generates positive cash flow above and beyond what investors demand. Number six, which is, if so, the project is worth undertaking. Okay, so what this EVA does is differs from NPV, is that the one glaring distinction here is measures. Number two, measures the investment performance on a year-to-year basis. So when we look at the NPV, it tend to look at the whole duration of the project, but EVA, it tends to look on a year-to-year basis. So let's look, what does that mean here? Okay, it says here the EVA method determines whether a project earns a pure economic profit. So what we are looking is that we are looking at, as being termed here, a pure economic profit. So a pure economic profit is a profit above and beyond, okay, the normal competitive rate of return in a line of business. So that is very interesting here. What does that mean, all this? Okay, let's look at the calculation here. Suppose that a certain project costs 100,000 upfront. One is not 100,000, it's a 1 million upfront, but after that it will generate a net cash inflows of each year in perpetuity of 120,000. Okay, to calculate the NPV of this project, we simply discount the cash flows and add them up. If the firm's cash flow capital is 10%, the project NPV is. So basically here what we are doing is that we're assuming that we are doing a perpetuity type of project, in which the project will last forever and every year is going to generate 120,000. So we can able to find what is the present value of perpetuity. We know the perpetuity formula is basically is CF divided by your required return, which is divided by R. So given the fact, it will give you somewhere around 1.2 million minus 1 million. So based on NPV, it will give you 200,000. So that's the way how we were to evaluate this project, as opposed to the using this EVA method here. To calculate the investment economic value added in any particular year, we start with annual of $120,000 cash flow, which is here. Next, we assign a charge that accounts for the return the investors demand on the capital invested by the firm in the project. So in this case, the firm invested $1 million, okay, which is supposed to sit over here, and investors expect a 10% return, so it will be over here. This means that the project's annual capital charge is 100,000, which is resulted from here, from the cost of capital, which is 10%, which is here, times the invested capital, which is 1 million here, and then it becomes 100,000. So therefore, the EVA is basically from projected cash flow from minus the charge for the invested capital, which is the whole amount here, which comes around 100,000. So the EVA is 20,000. Okay, so here what you're doing here is interesting, is that what this EVA does is to to evaluate in any particular year. Okay, you're talking about on a yearly basis, not the whole duration. So here we are just taking just a sample of 1 year, since every year is going to generate the same amount of money. So we take the projected cash flow, which is 120,000, and as far as the capital expenditure that is being spent, we are talking about the amount, the expected return from that invested capital, which is the cost of capital, which is 10% times the invested capital. So you get 100,000. So it turns out the amount here that we gotten from this using the EVA is the value, or the amount is, or the economic value here is the same as when we were to do doing the NPV. So, but here is quite strange, because I think why I think the method is not so popular, because you're looking at on a year-to-year basis, and there's and the way how it does it is that it takes the as far as the returns invested, it's applied against the invested capital. Okay, so let's look at the perspective of this the video. What do they say about this EVA method?
The economic value added metric helps shareholders of a business determine how their capital is performing versus other potential investments. It is also a useful calculation for companies deciding on the most economically valuable project to pursue. A simplified calculation of economic value added can be made by subtracting the opportunity cost of capital from the company's earnings. To do this, take the net operating profit after taxes and subtract the amount of capital times the minimum rate of return that would entice an investor. For example, Jim's friend owns Shockwave Electronics and wants to open a new location. A $50,000 stock purchase from Jim would help pay for the expansion, which the company projects will earn an additional $5,000 a year in profit. Jim wants at least a 15% return on any capital he contributes to the company. Using the EVA formula, Jim finds that he actually incurs an economic loss when compared to other choices. One alternative for Jim is to invest his $50,000 in a highly rated corporate bond yielding 4%, resulting in a $2,000 annual yield. EVA can be a complicated calculation with a number of variables involved. However, when investing in capital-intensive industries, EVA can be an effective tool in ensuring that you're targeting the smartest investments.
What it's trying to say here, what it's trying to say here is what he's trying to say here is that this is an investor, when wanted to invest, he's looking at the opportunity cost. If I were to put some amount of money, these are the percentage that I would like to get from my initial investment. So that's the reason why you have the cost of capital, you apply it against the initial investment, because these are how much, and then these are the projected cash flow. In the video, it shows the no part, which is net operating profit after tax. In other words, the expenses, you exclude the interest expense. But anyway, whatever it is, how the methodology you wanted to use for the projected cash flows here. But here we are talking about on a yearly basis. Okay, so that's the reason why. So you're looking in much more detail the contribution of that investment on a yearly basis. So let's look at the nutshell. What does it say about this EVA method? In other words, this project earns more than its cost of capital each year, so the project is clearly worth doing. To calculate the EVA for the project over its entire life, we would simply discount the annual EVA figures using the firm's cost of capital. In this case, the project produces an annual EVA of $20,000 in perpetuity. Discounted at 10% gives a project EVA of 200,000, which is 20,000 divided by 10%. So we have the cash flows the projected cash flows that will generate 20,000, which is basically, this is a perpetuity formula, which is a PV of it, which is 200,000, identical to the NPV. In this example, both NPV and EVA methods reach the same conclusion, namely the project creates 200,000 in value for shareholders. If the cash flow in our example had fluctuate through time rather than remaining fixed at 120,000 per year, then an analyst would calculate the investment EVA every year and then discount those figures to the present using the firm's cost of capital. So if the resulting figure is positive, the project generates a positive EVA and is worth doing. So in other words, EVA can be quite tedious because you need to know what is the economic value every year. Okay, if the numbers fluctuate every year, you have to find what it is every year. The EVA, meaning to say you take the value minus its opportunity cost, which is the cost of capital times its cost. Every year you have to calculate every year, and then you have to discount it back. Okay, so here it's just it's looking on the year-by-year basis, whereas in most of our valuation we are looking through the series of the project. Okay, so that is the negativity about using this EVA method. Okay, let's look at the one of the most popular method that we are normally being used is the IRR, looking at the internal rate of return. The internal rate of return, IRR, the discount rate that equates the NPV of an investment opportunity with zero, because the present value of cash inflows equals the initial investment. It is the rate of return that the firm will earn if it invests in the project and receive the given cash flow. So here what we are doing is that if we apply the same formula as the NPV, we are equating the NPV as zero here. So what we are trying to find is that if you were to run it from period T1 to period N, and we have a stream of cash flows here, and divided by our required rate of return, which is the, in other words, the return that we want to find, which is IRR minus a cash flow. So basically what we are looking at is that we are looking at the stream of cash flow when we discounted it is equivalent to the initial investment. Recognizing the projects may have cash inflows or outflows in any time period, including period zero, we can define the IRR more generally as zero is equivalent to period T to N and the stream of cash flow with the R1 plus IRR, which is the rate that we wanted to find. So in other words, if the IRR is greater than the cost of capital asset the project, if the IRR is less than the cost of capital, we reject the project. So what we are trying to do here by looking at this formula, the NPV formula, if you were to bring the CF, the initial cash flow, to the left, you are saying that what is the rate that we will equate all the stream of cash flows that we are getting, we expected throughout the period, so that it will be the same as the initial investment. Okay, so we are trying to find the present value of all this stream of cash flow discounted with a certain discounted return, and that discounted return is what the IRR that we're going to find. So our decision criteria is that, let's say we have our weighted average cost of capital reflected as a cost of capital, let's say around 15%. If the return of the project is greater than our weighted average cost of capital that we already set to invest in the project, then we accept the project. For example, if the project gives a return of 20%, the cost of capital is 15%, then we accept. But if the project only gives a return lesser than 50%, 15%, let's say around 13%, then we reject the project because it's not sufficient to cover our cost of capital, okay, that we've just learned in the previous chapter. Okay, Okay, let's look at the way how we were to calculate our IRR again. We can demonstrate the internal rate of return IRR approach by using the Bennett Company data presented in table 10.1. Algebraically, the IRR for project A is the number that solves this equation. So here what we are looking is that we are trying to make it a zero, all of these, which we have initial investment and these are the stream of all cash flows, and we are trying to find what is the IRR that makes it equivalent to zero. Again, we are looking for the discount rate that makes NPV of projects A cash flows equal to zero. So if you were to do that using the financial calculator here, what we do is that we press, first of all, we key in the 420,000 is the initial investment, press minus as a cash outflow, press CFJ. Then we have 140,000. Okay, that is the initial period for initial cash inflow. So we wanted to have it repeat for how many years? 1, 2, 3, 4, and 5. So you press 5, orange, and J. Okay, so you already key in. Next, you wanted to know what is the internal rate of return. Normally NPV, we press the percent first, but here we just press the IRR, which is the button here. We press orange and IRR, so you got somewhere around 19.866%, the rate that basically the rate in which we find that all the stream of cash flow is equivalent to the initial investment for the next 5 years. So in other words, these are the returns that we are getting from our investments. Okay, so that is the way how we calculate our IRR. Okay, more or less it's the same like calculate NPV, rather than it's just the last part in which rather than key in the percentages, we just key in the I. Normally when we were to calculate NPV, we would press the I, but here we just straight away press the IRR. Let's look at the second one here. Okay, I'll just do the second one, see how it works again, just to make sure everybody have the same understanding and how to do the calculation here. So later on, what I'm doing is, I'm not so sure whether you guys have this soft copy of this financial calculator. What I can do is I can just distribute it for those who haven't had, and probably Dr. Edie have already given, but just to make sure that you can also use it as a practice in your homework. Okay. But this soft copy of this financial calculator is not, especially it's not reliable when you were to calculate the bonds. Okay, when we wanted to calculate the yield to maturity. Sometimes when you wanted to calculate when the yield to maturity gets to negative, then it goes haywire. So there's a setback of it. But most of the time when we use this soft copy financial calculator, in which I do have the real copy here, the real financial calculator, but to show to the class, you would be use this soft copy. So in terms of time value of money is quite reliable, okay, but not really in terms of the bonds, where especially wanted to find the yield, not the present value of the bond, but the yield is where sometimes the numbers that it gives is a little bit weird, so you have to double check it. Okay, but anyway, let's continue with the second valuation on project B on the IRR using the IRR method. Let's look at the second project, which is project B, where it generates $280,000 first year, second year 120,000, and the subsequent year is 100,000. Given the initial investment is $450,000. So if you were to clear the numbers here, let's key in the initial investment, which is $450,000. So 450,000. So we press minus here, and then we press CFJ, and then the second one is 280,000, which is the second one. and the first one, and then we have 120,000, which is the second cash flow, and then the third cash flow is 100,000, and then then we have got the three of the same one, so we can just do the three repeated. So we press 3 orange and NJ, and then we press IRR, orange and IRR, so we get somewhere around 21.64, same here for project B. Okay, so it's the same as okay, more or less. So what can they derive here? Okay, let's look at what are the impact, the result that we have here. So comparing the IRRs for project A and B given in figure 10.3 to Bennett Company, 10% cost of capital, we can see both projects are acceptable because the returns on each project is greater than the cost of capital, okay, which is IRR for A, 19.9% is greater than 10%. R for B is 21.7%, which is greater than 10%. Comparing the two projects, IRR, Bennett's manager ranked project B over project A because project B delivers a higher IRR, which is 21.7%. For project B is greater than project A, which is 19.9%. However, if these projects are mutually exclusive, meaning that Bennett can choose one project or other but not both, the IRR decision technique would recommend project B. So what we are seeing here is that we can see a different result. Based on NPV, we find that project A, which is 110,000, project B is 109,000. We tend to choose project A, but using the IRR method, it seems that project B is much more attractive. So what do we do? How do you make decision? We've come up with this type of result, conflicting result. That will be interesting. Okay, that we will explore later on. But let's look first on the video on this IRR.
One of the most important jobs of any company management team is deciding upon which projects to fund and which projects to ignore. Nothing builds shareholder value like investing money in projects with positive economic returns. And nothing destroys shareholder value faster than wasting money on projects that cannot earn back the cost of their capital. Internal rate of return, or IRR, is one of the most popular methods of evaluating potential projects. Let's look at a project which will cost $10,000, but in year 1, it will return $2,000, year 2, $3,000, year 3, $3,000 again, year 4, $4,000, and in the final year, year 5, it will return $4,000. Let's also say that the firm uses 8% as a discount rate. The net present value would be $2,468. IRR calculates the discount rate at which the net present value of the costs of a project are equal to the expected net present value of the benefits. This is when the net present value of the entire project equals 0. The internal rate or return for this project is about 16%. The higher the IRR, the more valuable the project is. For projects with a single payout, IRR can be an intuitive, quick, and simple method of evaluating whether that project is worth further consideration. IRR is difficult to calculate by hand, but most spreadsheet programs.
All right, so that's the way how we being depicted. Basically the way how we done is that you can use trial and error. Last time when we don't want to have the financial calculator, or when we were to have a real test, a whole test, the students are given a choice whether they're using the formula or given the table. Okay. And usually, even using the table is very difficult to compute IRR. You need to use trial and error using the formula only then. So, but then we have already come through leaps and bounds, and right now, we don't worry. Then nowadays, since it's very open, you can either use a financial calculator or the apps. Okay, in order for you to figure out the rate of return for IRR. Okay, let's look at comparing NPV and IRR technique. Graph that depicts project NPV calculated at different discount rates. So how do we look? How we compare? Since we got here, why is that these two are given us a different result? how do you deal with that? So we'd like to see the reason behind this. Okay, so one of the ways that we need to come up with a graph, a better graph. And in order to come up with a graph, we need to know how to come up with a graph. Okay, so let's look at this slide here. To prepare net present value profiles for Bennett Company, two projects A and B, the first step is to develop a number of discount rate and net present value coordinates. Three coordinates are easy to obtain for each project. They are at discount rate of 0%, at discount rate of 10%, and the IRR. The net present value at 0% discount rate is the sum of all cash flow minus the initial investment. So as shown below there. For project B, when it is at 0%, the NPV is 250,000. The net present value for project A and B at the 10% cost of capital are 110,710 and 109,244 respectively, as shown in figure 10.2. Because the IRR is the discount rate for which net present value equals 0, the IRRs for based on figure 10.3 of 19.9% for project A and 21.7% for project B result in 0 NPVs. Table 10.4 summarizes the three set of coordinates for each of these projects. So here we can find, once we get three coordinates here, then it's easier for us to come up with the line curve, because in order to depict what actually happened when we were to do valuation using NPV and IRR. Let's look at the graph here, okay, that we already draw here. Of course, it is easy to generate more coordinates by simply calculating the NPV for each project and other discount rates. Plotting all of those coordinates results in the net present value profiles for project A, shown in the blue curve, and B, shown in the red curve. Number one, the IRR of project B is greater than of project A. So if you were to look at it, the project B at certain times it is greater than project A in terms of IRR. So managers using the IRR method to rank projects will choose B over A if both projects are acceptable. Number two, the NPV of project A is sometimes higher. Project A sometimes is higher and sometimes is lower than that of project B, as indicated here, depending on the discount rate. Thus, the NPV method will not consistently rank A above B or vice versa. The NPV ranking will depend on the firm's cost of capital. So, in other words, when it is lesser than 10.7, the discount rate, the project A has greater NPV, but is greater than applies a discount rate or the rate which is higher than 10.7, then B looks having a better NPV. So when the cost of capital is approximately 10.7%, which is here, project A and B have identical NPVs. Okay, so what we are doing here is that just would like to make some correction in what I've already stated in number one. Okay, here we come up with a line graph. Okay, the line graph, once we get all the three pointers, when NPV is at 0, these are the amount for project A and project B. One is around project B is when 0% rate R, then when we run it, project B gives 250,000 NPV, and whereas project A it gives 300,000. And then when it's at around 10% here, it gives you project A around 110, project B around let's say around 109,000. So if you were to draw the graph here, you can have it here. And then when NPV is 0 for project A, when the rate here, the horizontal is the discount rate, when A is around 19.9%, when NPV is 0 for project B, when it's at 21.7%. So you get three dots here, 1, 2, somewhere around here, and 3. So you can draw a straight line, okay? And you can also do for project B, you do a straight line. So when you were to do that, then we get a what we call intersection, where they join together. So this is not a curved line. This is basically a straight line. Looks like a curved line for each one of them. So meaning to say that based on this analysis here, okay, what we are looking is that we are looking at NPV. Whenever NPV, when we were to apply a rate that is lesser than 10.7%, project A is the preferred one. But if it's greater than 10.7%, project B is a greater one. But here, I think this is where I need to make the correction. The IRR for project B is greater than project A, so managers using IRR method to rank project will choose B over A if both are acceptable. For valuation, IRR is always shown that project B is always greater than project A. Okay, but when we were to look NPV, that's where we have a conflicting. Okay, because it depends on the required rate of return or the discount rate that we choose to evaluate. So why is that phenomena happen? Okay, the conflicting rankings is because of the reasons here. Conflicting in the ranking given project by NPV and IRR indicate from differences in the magnitude and timing of the cash flow. Reinvestment assumption. What's a reinvestment? Reinvestment is that if you were to use this 140,000 or 280,000 that we earn, we put back into the savings account, into the account back, we reinvest it. Okay, so we kind of put in, we don't spend it, we reinvest it. So the NPV calculation implicitly assumes that the firm can reinvest intermediate cash inflows at the cost of capital. So therefore, when we do this here, those two part is based on NPV method. The bottom two is based on the IRR method. So NPV, when we set a criteria of 10% as our required rate of return, the assumption is that the amount that we have here, that we reinvest back at 10%. Okay, so we reinvest back at 10%, so that when we would calculate, the value is based on the reinvestment rate of 10%, which gives a present value for project B of 559,000, for A is 530,000, and then we offset it against the initial investment. But as far as when we use the second method, the IRR approach, however, assumes that the firm reinvests intermediate cash inflows at a rate equal to the project IRR. So here in IRR, what we are assuming is that once we get the rate of return is 19.9%, we are saying that all this amount, when we were to put it back, we are putting into the account back as at 19.9%. So same with this one for project B. When we calculate, it gives a return of 21.7%. We're assuming all this amount are being reinvested back at 21.7%. So due to the what we call the differences in the reinvestment that rate, so the calculation that we got here in terms of which one do we choose, that's the reason why NPV gives another preference, whereas using IRR, it gives another preference, which is project B. So what do we say? So the question back is, which one is a better method? How do we see? How do we choose it? Which approach is better? Theoretically view, one theoretical basis, NPV is the better approach to capital budgeting for several reasons. Most importantly, the NPV measures how much wealth project creates or destroys if the NPV is negative for shareholders. For an investment project, the NPV calculation always provides a single answer, but sometimes the IRR calculation has more than one solution. So sometimes you have multiple IRRs, more than one IRRs resulting from a capital budgeting project with an unconventional cash flow pattern, the maximum number of IRRs for a project is equal to the number of sign changes in each cash flow. So what does that mean is that here when we had NPV, when you apply a certain rate, because when you make investment in project, you know what is your cost of capital. You know, okay, this is what I need, okay, to get a return from investing this project. So I need to know whether with that cost of capital or whatever cost, maybe you have a cost of capital, you add another premium rate, you know, just to show that you need to have extra what do you call incremental rate to justify the margin in terms of the profit that you like to have on investing. Let's say 15% is your cost and you hike up to 70% to show that you need to have some extra to eat. So you increase by 70%. So when you calculate the NPV, it will give you the NPV, the value, whether it comes with 100,000, a million, 300 million, or whatever. So you can see the real value, the added for which is the present value of right now. You netted with the cost, so you can see the value maximization to the shareholders. But when we look at the IRR simply gives you a rate, okay? So sometimes the rate is very difficult. So maybe a certain projects, you said it gives a rate of 12% as compared to the other project, it gives a rate of 15%, but it doesn't give you in terms of the impact of the dollar amount. So so which one you would have choose in that sense? In this case, it would say that literally, because you can see the real value much more on the dollar sign, so NPV will be better, even though IRR give you the percentages. But what does that percentages mean? Does it talk about 100,000, millions of dollars? So that is the question. Sometimes when we do deal with IRR, when we deal with conventional cash flows, you got minus 1 year, got positive another year, minus another year. Sometimes when we calculate the IRR, you can get a double two answers, okay, because of the unconventional. You got on the negative IRR, you got a positive IRR, so you get two answers there. So it can create a confusion. So so there's a verdict based on which one comes when you have a conflicting answers. One says NPV says this one is better, whereas IRR shows the other one is better. But most of the time, both of them would agree to each other. Okay, only a certain times, you know, that they would comes with a different result. Okay, let's look at what the video says about this.
Using internal rate of return and net present value for capital budgeting evaluations often end in the same result. But there are times when using NPV to discount cash flows makes more sense. IRR uses one discount rate, which is okay when evaluating projects that share a common discount rate, predictable cash flows, equal risk, and a short time horizon. But discount rates usually change over time. IRR does not account for changes, making it a poor option for longer-term projects with varying discount rates. IRR calculations are also ineffective for projects with a mix of positive and negative cash flows. Consider a marketing project that must be updated every couple of years to remain current. Its cash flows are negative $50,000 in year one due to the initial outlay. It returns $115,000 in year two and costs $66,000 in year three when the project receives a new look. NPV can discount each cash flow separately, making it a better option. Using NPV also works better when a project's discount rate is not known. The IRR has to be compared to the discount rate to gauge a project's feasibility. If the IRR is higher than the discount rate, it's a good project to pursue. If a project's NPV is above zero, it's financially worthwhile.
So here we are talking about two major techniques that normally most investors or analysts they would apply. Okay. So which methods do company actually use? Researchers have surveyed chief financial officers, the CFOs, about what methods they use to evaluate capital investment projects. One interesting finding was that many companies use more than one of the approaches we've covered in this chapter. The most popular approaches by far were IRR and NPV, used by 76% and 75% respectively of the CFOs responding to the survey. These techniques enjoy wider use in larger firms, with the payback approach more common in smaller firms. So usually you tend to use IR and NPV, but at the same time you have supplement using the payback. So I think that's all for today's lecture. Okay, so any questions regarding this? We got a few more minutes before 5 o'clock. Turns up before 5 o'clock, yeah, before 5 o'clock. Okay, so let me put my face here. Okay, if there's no questions, we'll see you guys back in 2 weeks time. Okay, because next week we have got semester break, so what happened here? My face just disappeared. Okay. Hold on, what happened here? Okay, all right, my face is still there. Okay, somehow you get switch menu, switch to another menu. So during that semester break, please work on your assignment, so that you are not rushing too much during the last week to finish up the assignment. Okay, so if there's no question, okay, see you guys, and those who are celebrating Hari Raya, so just would like to wish you Selamat Hari Raya then. Okay, so thank you, and see you guys in 2 weeks time. Okay, bye.
Thank you, Doctor.
Thank you, Doctor. Selamat Hari Raya.
Okay, all right, okay, thank you. Okay, bye. Okay, see you guys, bye.